Brian Jacobsen, our chief economist at Annex Wealth Management. Also on the show helping us finish up is Tom Parks, director of retirement plan services at Annex Wealth Management. These gentlemen have been in their corners with their trainers getting fired up for this. What you do is 401ks, right?
That is correct.
Right.
All day long, Danny.
All day long. Chief economist, Brian, you see all sorts of stuff.
That's right.
You really see how private equity works, doesn't work, can work. Looks like it's poking its nose into 401ks. Can you just give me a quick recap of what's going on?
This was really motivated by an email that Tom had sent because he meets with all sorts of different, what do you call them, like mutual fund companies?
Wholesalers, representatives of the companies.
Yeah, and didn't you encounter somebody who was saying about, hey, we have this shiny new object?
Yes, I've been seeing more and more of it, but we did have a conversation about, hey, we're going to roll something out that offers access to plan participants, people who are in 401k plans, access to private equity through this vehicle that, you know, I thought about it for a while, then I sent an email.
That's right. It rubbed you the wrong way. But and part of it is I think everybody might have different conceptions and ideas about what private equity is, who is it appropriate for, who is it not appropriate for. Maybe you can just take a little step back, talk about what private equity is.
I think that's a huge thing because that's part of the bone I have to pick with this concept.
That's right, because I think a lot of people see headlines about private equity firms that go in, they buy a company, they sell it for its parts. And I think that a lot of people think about private equity in those terms. They're ruthless, go in, they buy a company, and then they just flip it. They fire all the employees, and they get their pound of flesh, and they move on. But what I have found is that more and more private equity firms are actually really trying to identify companies that are undervalued and that they can bring value to the company to help it grow without doing the slashing and burning that is sometimes associated with them. There are differences in the perceptions, and maybe it's just because I've been working with some private markets providers, private credit, so those who lend money, private real estate, so they own properties, and private equity, where they're the ones who are going in, buying, oftentimes controlling interests in firms in order to try to help them grow.
Well, that's Brian's nuanced look at it. Tom, how about you?
All of that I think is good. My concern is dealing with just regular people day in and day out. I've been doing this for 25 years. Is people, whether it's in the conferences that I go to or on TikTok or whatever, there are these trends that happen. And all of a sudden you use the perfect word, Danny, shiny new object, whether it's like Bitcoin in 401ks. I was like, you got to be kidding me. I cannot believe we're actually talking about this. But I look at private equity, and it's not necessarily that I have a concern with private equity itself, although part of what you talked about, you know,
the slashing and burning.
Right. There's that reputation, but you're also correct. Most of it is not that. It's really people trying to build value. My concern is that people hear about it. They get this idea that I'll make tons of money, and then they want to move into it. This is why we do the education. I don't like people investing in stuff they really don't understand at all. And private equity is kind of complicated. More
than kind of complicated. Requires specialized training, I think, to understand exactly what's going on. What is the value added proposition? We have to consider, is it appropriate for the investor? And for, I would say, the vast majority of people, probably not. If you consider that private equity, number one, these are oftentimes firms that are a lot smaller than what you see in publicly traded markets. Companies that maybe you see in the neighborhood and that, but these are not publicly traded. So there's a large number of them, but they're also a lot smaller. Oftentimes, when you're investing in private equity, you have to be concerned about what are the fees that you're paying to the manager, because they're getting paid a pretty penny for what they do.
Important to be aware of. And sometimes that's not easy to understand. That's the other thing. It's not super transparent.
And the lack of liquidity as well, if you want to get out. And that's where I get problems with people thinking, I need to buy this. It's like, well, this is more like a long-term relationship, because if you want to get out, you might not be able to for a few years or even longer. It really depends on the structure of how you're getting the exposure. And it comes with those heightened risks. Smaller companies, they oftentimes have less liquidity, higher fees. Yes, there can be a lot of situations where it does pay off, but for, I think, the majority of individuals, there's a reason why the SEC, the Securities Exchange Commission, they have rules about who qualifies to invest in these. Accredited investors. So you need to have a certain amount of either competency or assets that you can afford to lose, or are you a qualified investor? There's all these different levels of qualifications to be able to invest in these things. So I was a little surprised to hear when you were talking to a wholesale. I was like, hey, let's maybe
So
look
I'm
at
not,
having
for the
this
record,
there.
I'm not opposed. I just want people to know, buyer beware, do your homework. That's the key
Yep,
thing.
absolutely.